All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Thursday, everybody. Today's September 5th, 2024. And the top story or stories this morning is the labor data that we've gotten over the last 24 hours or so. We've gotten several different reports: JOLTS, job quits, Challenger, ADP, initial and continuing jobless claims. And most of them, not all, but most of them are pointing towards further weakness in the labor market and a bad jobs report tomorrow morning. And you better be careful, guys, because that jobs report tomorrow morning is going to be a big one. Now, remember a month ago what happened on those jobs numbers. We got, I believe it was August 2nd, we had the jobs report came out, and it was a lot weaker than expected. Far fewer jobs were added, plus a big downward revision. And the market had already been selling off a little bit, and that we already had the Japanese intervention in the yen market, and people were starting to whisper about the carry trade. And then after that jobs report on Friday last month, market just, the bottom fell out, culminating ultimately in that August 5th bloodbath in markets. And of course, the powers that be rigging markets and shutting down all the brokerages, so nobody was allowed to sell, something the SEC still hasn't done anything about. But I digress. The setup is looking very similar to that right now, where we got a yen strengthening. We actually had a yield curve just uninverted last night. All right, the much anticipated uninversion of the yield curve, that is here. But then we got all this jobs data that is adding to this. So let's talk about it a little bit. JOLTS came out yesterday, job openings and labor turnover survey. It was a big miss to the downside. 7.673 job openings in the United States, 7.673 million job openings in the U.S. The market was expecting about 8 million. So a miss of 400,000 plus. That's down by 237,000. Also downward revisions to the prior month's numbers. Just terrible. And this is on top of the fact, I was talking about this on Twitter yesterday, that a lot of those job openings just aren't real. There's a lot of ghost jobs posted and multiple postings for work from home positions. So even JOLTS, even though you can't trust the absolute number, you can see in the trend it's heading in the wrong direction. We also got Challenger job cuts this morning. 75,891 jobs were cut in the last month. That is the most since 2020. Is that accurate? No, that's not. Anyways, a lot more job cuts than expected, up from 26,000 last month. So we've got more announcements of job cuts. My friends over at MacroEdge have done an excellent job of documenting the rate at which layoffs were announced. Over 100,000 layoffs announced in the month of August again. So that is further weak labor. We got ADP private payrolls this morning. Now, ADP, that's a private organization. It's not a government statistic, but that one came out adding 99,000 jobs, well below the 145,000 that were expected in the ADP payroll. So big, weak number from ADP there. That's down from 111,000 last month. And I would add that 111,000 from last month, that includes 11,000 in downward revisions. It was originally reported as 122,000. So ADP showing a lot of weakness here. And then we got initial and continuing jobless claims that came out just a few minutes ago. Those actually weren't too bad. Initial claims, 227,000. That's down from last week. Continuing claims, 1,838,000, also down from last week. So taken as a whole, JOLTS, ADP, Challenger, bad. Initial and continuing, slightly better than last week. So what does this tell us about the whole picture? I'm going to go with the 3 out of 4 being bad. Tells me we're probably looking at another lousy jobs report tomorrow. Now, maybe expectations are already low enough because of what we saw last month. So maybe there won't be any big surprises, and maybe that's already priced in. That's a possibility, but it is not looking very good for the job market at the moment. Also going on this morning, yesterday we were talking about how Nvidia had received a subpoena from the Department of Justice. Well, late yesterday, Nvidia comes out and says, "Nuh-uh, we didn't get no subpoena." Nvidia's denying it. So either Nvidia's lying, or maybe Bloomberg got this one wrong, or maybe they're just splitting hairs over pointless semantics and being the unbearable schmucks and a-holes that they are over at Nvidia. It might have something to do with a civil investigative demand, and you have to have your pinky up when you say that. Nvidia is being kind of petty with the semantics this morning. We'll talk about that story. Jeep is cutting back production on the Wrangler and the Cherokee due to too much inventory. Not a good sign there. Also, not a good sign for the labor market. No mentions of layoffs in this article, but they're cutting back production, guys. Inventory piling up at the dealers' lots, and so they're making cars. It's the best economy ever, isn't it? We talked about the yield curve. The federal government plans to block the merger of U.S. Steel with Japanese-owned Nippon. That's another big story that hit the tape yesterday. That's a very big merger that may be a political issue, even though both candidates have come out opposed to the merger. The U.S. Steel merger with Nippon was a very big deal in my home state of Pennsylvania, where what's left of the U.S. steel industry still resides. We'll talk about that one. JP Morgan Chase is out with a note about China saying, watch out for China. Don't buy. U.S. tariffs are coming back. They're calling it the second wave of tariffs now. So JP Morgan analysts are warning that the bottom is not in for China. And as it happens, we got news out of Country Garden. Their sales year over year are down more than 57%. We just got that data this morning, and their auditor quit. Oh, that's always a good sign. PricewaterhouseCoopers, or an affiliate of PricewaterhouseCoopers in China, was the auditor of Country Garden. They are in big trouble because of what happened over at Evergrande, one of the biggest accounting scandals in history over there. And so they are resigning as Country Garden's auditor. That's always a good sign, right? When your auditor quits? Oh, it's not a good sign. Oh, okay. Well, we'll just pencil whip right past that one, shall we? And last but not least, this morning, another merger was announced. We got Verizon is buying Frontier Communications for $20 billion, representing a 37% premium over Frontier's price. That one was announced yesterday. The stock was up big yesterday. That's down a little bit, giving back some of those gains this morning. And we got another one, C3 AI. It's not one you hear about too often. It's about a $2.6 billion valuation. Big surprise, they don't make money. Well, I guess that's not a big surprise because no AI companies make money. Only the hardware and the cloud providers make money in AI. The companies that are actually making the artificial intelligence, none of them make any money. Well, C3 AI, their stock is getting crushed this morning after reporting a big revenue miss. They are on pace to burn $600 million in cash this year. They're going to lose $600 million on a $2.6 billion valuation. So shocking news this morning. AI still doesn't make money, even though a $16 trillion stock bubble has been created around this technology. We got a lot of stories to cover this morning. Why don't we shrink my big melon of a head? And don't forget that like button while we're doing that, guys. And if you're new here, hit that subscribe button because we do this every morning. So come have your coffee with the melon heads as we go through markets. We've got the S&P is currently negative, albeit just barely, 2.6 points to the downside or 0.05% lower ahead of the opening bell. A little bit of bouncing around on some of those labor numbers this morning. The Dow, meanwhile, is in positive territory now, up 16 points, 0.04% higher for the Dow. And the NASDAQ is leading the way lower, down 53 points, or 0.28% lower for the NASDAQ. So stocks, kind of a mixed bag here. A little bit of positivity in the Dow, but the rest is down. We've got a weaker dollar this morning. The U.S. dollar index, or the DXY, down 22 basis points to 101.14. So that weaker dollar will put a little bit of upward pressure on the stock valuations this morning. Speaking of the dollar, guys, this is one to keep an eye on. Let's take a look. This is USD JPY, the number of yen it takes to make $1. And I got to point you right here, this 3-day slide in the yen. That's why I'm warning about the setup heading into tomorrow's non-farm payrolls report, guys, because this was the setup heading into the non-farm payrolls the last time. Now, actually, I should say, let me correct. This was the setup heading into the non-farm payrolls last time. Then this was the payrolls themselves. And then this was that Monday mayhem that we saw. I don't know what I'm drawing here. A lot of squiggles on the chart. But a strengthening yen. The yen continues to strengthen. That is a key ingredient in the unwinding of the carry trade, in the unwinding of the AI trade, and of course in this unwinding of the short vol trade, which also didn't do so well this week because the VIX was up big. So we've had three big red candles in a row on the yen. It's strengthening as the labor data points to weakness, as we've had some bad signs in the AI trade between the super micro short report last week and then the Nvidia subpoena or not subpoena, whatever the hell you want to call it, story. The setup for a repeat of that August 5th is getting very tight here. So keep an eye on that one. And another thing to keep an eye on, guys, this is the Nikkei 225, the Japanese stock index, and that is also showing a similar setup. We've had a little bit of weakening over the last few days, and here is that early August sell-off that we saw in Japan stock. So again, the table is kind of set for tomorrow morning here to kick off another one of these mayhem messes, whatever you want to call it, in markets. Is it priced in, though? That's the question. Is that negativity already priced in? Let's shift gears a little bit to the bond market. And by the way, we'll go a little bit out of order here, but well, now we'll talk about it in a minute. The bond market right now, 30-year Treasury, 4.037, down 3 basis points this morning. The 10-year, 3.725, down 4 and change. The 2-year, 3.717, down 5 and change. And you may notice at 3.717, the 2-year Treasury yield is lower than the 10-year at 3.725. So we have got the uninversion of the yield curve. It is finally here. Oh boy, this has been one of the longest running, steepest inversions the yield curve has ever seen. And remember, guys, the yield curve has inverting. It has a near perfect record of predicting a recession. This is the most severe inversion the yield curve has ever seen. And it has just uninverted. And typically it is the uninversion that marks the beginning of the recession. So you can start your watches right now on September 5th, 2024. The yield curve doth uninvert. Also, the 1 month is at 5.17. That one has been moving down pretty steadily ahead of those rate cuts that are expected in a couple of weeks here. We're seeing the 1 month Treasury yield is starting to head towards 5%, down almost another 3 points this morning. Now, looking over at the commodities board, we've got spot gold is back above 2,500, where it belongs, $2,514 for gold. That's up $18.90 this morning, about 0.75% higher. Spot silver is also up this morning at $28.76. That's up 50 cents or 1.77% higher. We got a lot of green here. Copper is up 1.1%. Platinum is up 2.4%. Palladium is up 0.64%. And even oil is up a little bit here, 0.87% higher for October WTI crude oil futures, trading at $69.78. That's up about 58 cents this morning. Meanwhile, the Bitcoin is down once again, $1,300 lower. It's priced on Coinbase, $56,626 for Bitcoin. Bitcoin is struggling here as the tech stocks continue to struggle. And as that yen carry trade unwinds, that is going to put some downward pressure on Bitcoin. And real quick, let's just get this one out of the way. This story is ridiculous. This one hit yesterday. Nvidia says it has not been subpoenaed by the DOJ in a probe. So we had this story yesterday. We talked a lot about it, how Nvidia was hit with a subpoena and these ongoing trust actions. Now, does this mean Bloomberg was wrong in that story yesterday, or does this mean they're just a bunch of unbearable pricks over at Nvidia? Let me know in the comments, because check this out. Nvidia responding to a Bloomberg news report about the U.S. Department of Justice sending out subpoenas as part of an antitrust probe, said it has been in contact with the government agency but hasn't been subpoenaed. The DOJ often sends requests for information in the form of what is formally known as a civil investigative demand, which is commonly referred to as a subpoena. The Department of Justice has sent such a request seeking information about NVIDIA's acquisition of Run AI and aspects of its chip business, according to one person with the direct knowledge of the matter. So NVIDIA here is saying, no, we haven't been subpoenaed. And then this source at Bloomberg is saying, eye roll. It's a civil investigative demand. If you want to go on a legal website and look up the difference between a subpoena and a civil investigative demand, if you squint very closely and turn your head at least a 15-degree angle and close one eye and hop on one foot, you can kind of see the difference between a subpoena and a civil investigative demand. This is a kind of a ridiculous story here. It really looks like NVIDIA is just like, nuh-uh, it's not called a subpoena. The actual formal name is civil investigative demand. It's the same thing. They call it the same thing because the difference is so subtle, it's not worth splitting hairs. But if you're a company like Nvidia, maybe it is worth splitting hairs over. So I don't know. Let me know, guys. Was Bloomberg just wrong with this story, or is Nvidia just being themselves this morning with this one? I don't know. But let's shift gears here and let's talk about the labor data. First things first, this one came out yesterday, JOLTS, or Job Openings and Labor Turnover Survey. This is the number of jobs posted in the United States, and the number of job openings fell by 237,000 to 7.673 million in July, from a downwardly revised 7.91 million in June, reaching the lowest level since January of 2021. Yikes. And below market forecasts of 8.1 million. So a huge miss here. Forecasts of 8.1 million. They missed by almost 500,000 job openings. The number of openings decreased in healthcare and social assistance, state and local government, excluding education, transportation, warehousing, utilities. But it increased in professional and business services. That's interesting, as in the federal government. Meanwhile, both the number of hires and total separations changed slightly to 5.5 and 5.4 million, respectively. Now, here you can see the number of job openings, guys, another new low. It's been falling all year here. Now, if you set this to a 5-year trend line, you can kind of get a better idea of the number of job openings. That huge increase, that was the onset of work from home and multiple job postings. It made a big step change up. But since March of 2022, coincidentally, that is exactly to the month when they started quantitative tightening and when the first rate hike was announced. You can see the job openings have fallen precipitously. We are still, though, well above the pre-pandemic levels, but it's important to remember, I believe, in my opinion, several million of these 7.67 million job openings are fake ghost job openings. There's no intention of the companies of filling them, or they're duplicates, the same job posted in multiple cities being counted multiple times. Shout out to my buddy, the Happy Hawaiian on Twitter, who first alerted me to that one over a year ago now. Now, yesterday in the same JOLTS report, we got job quits, the number of people voluntarily leaving their job. The number of job quits in the U.S. edged up to 3.277 million in July, from a downwardly revised 3.214 million in June, which was the lowest level since September of 2020. The quits rate, a metric that measures voluntary leavers as a portion of total employment, was 2.1%. Compared to 2% in June. Quits increased the most in private education and health services, leisure and hospitality, manufacturing, government, and information. So slightly higher on the quits, but slightly higher than a low that was seen last month. If we zoom out on this chart, you can kind of see the same thing as JOLTS. The number of voluntarily leaving their job has been falling pretty rapidly since the start of the Fed's tightening cycle. Now, this one actually is below pre-pandemic levels, where we had 3.57 million people quitting, and now we are at about 3.25 million people quitting. So fewer people quitting their job. That's because they have less confidence that they'll be able to find a new job to replace it. Again, a weaker job market. Now, this morning, we got even more labor data. We got challenger job cuts. U.S. employers announced 75,891 job cuts in August. That is the most in 5 months and the most for the month since 2009. I think they're trying to say the most for the month of August since 2009. That's when excluding the pandemic-induced crash in 2020. The result was in line with other key releases, reflecting a softness in the U.S. labor market, strengthening the rhetoric for doves at the FOMC. August's surge in job cuts reflects growing economic uncertainty and shifting market dynamics. Companies are facing a variety of pressures, from rising operational costs to concerns about a potential economic slowdown, leading them to make tough decisions about workforce management, said Andrew Challenger, Senior Vice President of Challenger Gray and Christmas. So here is the Challenger job cuts. You can see here we had a couple of months of, it looked like, lower job cut announcements, and then we got a big surge in August. So more jobs being cut. Again, weakness in the labor market. And then probably the worst one, I don't know, maybe JOLTS was worse than this, but ADP payrolls, which, guys, ADP, it's private sector numbers. So this is known to differ from the non-farm payrolls. That's an important asterisk. But directionally, this is pretty big. Private businesses in the U.S. added just 99,000 workers to their payrolls in August of 2024. That is the least since January of 2021. I would add that is versus 145,000 expected. So this is a huge miss for ADP payrolls. This follows a downwardly revised 111,000 in July and well below the forecast of 145,000. The initial July number was reported as 122,000. Now that's been revised down to 111. So even the private sector numbers getting in on those downward revisions these days. Figures showed the labor market continued to cool for the fifth straight month while wage growth was stable. The job market's downward drift brought us to slower than normal hiring after 2 years of outside growth, said Nella Richardson, chief economist at ADP. So again, declining job creation here in ADP under 100,000, and that is the lowest in quite a while. We got a little bit more labor data. Initial jobless claims came in the U.S. They decreased to 227,000 for the week ending August 31st. That's down from 232,000 in the previous week. So this data is not as bad as some of the other data points. There's your 227,000 initial jobless claims. A little bit of a downtrend that I'm noticing here since that peak at the end of July. Maybe that's a silver lining here. Maybe that means the jobs report tomorrow won't be that bad, right? This data still slightly elevated, right? We're at this slightly higher level than we were last fall and last winter, but trending down over the last 5 or 6 weeks or so. Same thing with continuing claims. Continuing jobless claims in the United States decreased to 1,838,000 in the week ending August 24th. That's down from 1,860,000 in the previous week. So fewer continuing claims as well. That's actually a pretty substantial drop. Almost 20,000 there, the decline in continuing claims. So we've got JOLTS was bad, quits was bad, Challenger was bad, ADP was bad, but initial and continuing claims were good. So what does that tell us about tomorrow? I'm still leaning towards a weak jobs report tomorrow because I have seen nothing in this data that changes my opinion or changes my leanings on the direction the job market is heading in. But again, the pace of it, the scale of it, and you always have to remember that fudge factor, guys. The government, they may just make something up, right? I mean, it's an election year. This is one of the last jobs reports before election day, so this is big. Would you put it past them to just totally fudge the numbers up by 200,000 just to make things look good heading into the election? I wouldn't put it past them. Also, let's keep an eye out for downward revisions to last month's number. That was already terrible by itself. So we'll see tomorrow morning. Tune in tomorrow morning for the morning live stream when we'll talk about that one. Also, here's another important sign of weakness in the labor market. Jeep cuts output of Wranglers and Grand Cherokees. Further weakness in the auto market, guys. And, EVs has had a lot of trouble in the last couple of months, in the last year or two, and I've been pounding the table on EVs. But looks like internal combustion engines are right there with them. I mean, here we go. Jeep's parent company has pressed pause on making 2 of its top-selling models. Factories temporarily stopped producing the Jeep Wrangler and Grand Cherokee sport utility vehicles in the past week. People familiar with the matter said those models were among Jeep's best sellers through the first half of the year. In a statement, Jeep's parent Stellantis on late Wednesday confirmed production adjustments at 2 Detroit assembly plants that make the Grand Cherokee and another factory in Toledo where the Wrangler is produced. How many days the facility have been idled couldn't be determined. The production cuts come as Stellantis grapples with some of the industry's highest inventory levels and as sales have sagged, triggering complaints from dealers. So again, it's the best economy ever, and that's why the car factories are making fewer cars because they're sitting on dealer lots and they're not selling. It's the best economy ever, haven't you heard? By the way, I got to send a shout out once again to my friends at MacroEdge who tipped me off to this story. Thank you, MacroEdge, for all that you do. They do excellent job of tracking job cuts, layoff announcements, and stories like this in real time. So check out MacroEdge RES on Twitter or X, whatever you want to call it, and tell them nobody sent you. Another big one we got yesterday, guys. Biden to block Nippon Steel's proposed takeover of U.S. Steel. This is potentially an election issue. I don't, maybe not so much because both candidates were opposed to this merger. So I don't think this is really going to help or hurt one candidate here. But this is a big deal because this affects Pennsylvania, which is a swing state. U.S. President Joe Biden is preparing to block Nippon Steel's $14.1 billion takeover of United States Steel Corp., according to people familiar with the matter. But U.S. Steel, responding on Wednesday evening, vowed to pursue all possible options under the law to ensure that the sale is completed. The proposed deal has been subject to a review by the Secretive Committee on Foreign Investment in the United States and Biden plans to kill it as soon as that committee referral lands on his desk, said the people who asked not to be identified because the move hasn't yet been announced. A decision could be made as soon as this week, they said. The Washington Post earlier reported on the plan. Now, it's important to note, guys, that this may result in further shutdowns in the steel industry. If the Nippon deal is successfully blocked, the fate of U.S. Steel remains unclear. The company warned Wednesday that failing to complete the deal would imperil thousands of jobs and force the company to pivot away from some of its legacy blast furnace facilities, including those in Pennsylvania, and potentially even relocate its headquarters from Pittsburgh. Now, guys, the steel industry has been in turmoil for years, really, but it's been particularly bad lately because of what the Chinese have been doing with the dumping of steel. The Chinese are not slowing down their steel mills, even though they all lose money. The Chinese government subsidizes those losses, and then the Chinese dump that steel on the open market, collapsing the price globally. Not so good if you are a higher cost competitor in the United States. So U.S. Steel not doing so well yesterday. They lost 17.5% on that news. Although it looks like they plan to challenge this in court, the stock has rebounded about 2.4% ahead of the opening bell this morning, trading at $30.08. That's up about 70 cents. Now, speaking of that Chinese steel fiasco, JP Morgan abandons recommendation to buy China stocks ahead of the U.S. election. This one is out this morning here. JP Morgan abandoned its buy recommendation for Chinese stocks, citing heightened volatility around the upcoming U.S. elections, in addition to growth headwinds and tepid policy support. China was downgraded to neutral from overweight in the bank's emerging markets allocation. Strategist led by Pedro Martinez wrote in a note on Wednesday, the potential for another trade war between Washington and Beijing could weigh on shares, while China's moves to lift itself out of its economic slump remain underwhelming, they said. The impact of a potential tariff war 2.0, with tariffs increasing from 20% to 60%, could be more significant than the first tariff war, the analyst wrote. We expect China's long-term growth to trend down structurally due to supply chain relocation, the expansion of U.S.-China conflicts, and continued domestic issues, they added. So look, if Biden wins, the tariffs stay. If Trump wins, the tariffs get worse. Either way, you probably don't want to be invested in China right now. A lot of people have been trying to call a bottom in China. It has not really worked out so well. And we got more bad news out of China this morning. Country Garden's home sales tanked 57%. as liquidity stress worsens. Now, this one just hit the tape this morning as well. Country Garden Holdings sales slump dragged on in August, exacerbating the Chinese developers' liquidity woes as it battles a wind-up petition. Contracted sales for August declined 57% from a year earlier to 3.43 billion yuan, or $483 million. That's following a 72% drop in July, according to an exchange filing on Thursday. So, all right, there's two different ways we could look at this. We could look at this and say a 57% decline in sales, that is terrible any which way you possibly look at it. Or if you want to be a cheerleader and the ever optimist, something I don't really subscribe to, you could say, well, sales are down 57%, but at least it's not the 72% drop that we had last month. So maybe if you guys want to be optimistic, you take optimism for a spin, you give it a try. Again, it's not my cup of tea, but things at Country Garden just not going well here, guys. And you know what? I was almost done with this story this morning when I scrolled a little bit past all the ads for all the other articles. And then I came to this one, also out today. Almost missed it. PricewaterhouseCoopers resigns as Country Garden's auditor amid regulatory probes. That's always great when your auditor resigns abruptly, right? PricewaterhouseCoopers resigned as auditor for defaulted developer Country Garden Holdings as both firms navigate challenges to keep operations afloat in China. The real estate company said PwC is unable to fulfill the timetable requirements for the company's need to publish its overdue financial statements for 2023. PwC will be replaced by Hong Kong-based Zhang Hui, according to a filing. PwC is facing a 6-month ban as part of punishment over its role in auditing failed developer China Evergrande Group, a person familiar said in August. If the penalty is handed down, it's expected to stop PwC China from signing off on financial results and restructurings based on previous cases. The company declined to comment. So we got 57% declines in sales. The auditor is resigning because, well, they've been banned from signing off on books, or they could be banned from signing off on books in China because of what they did with Evergrande. Does it feel like a bottom is in China to any of you guys? Does it feel like the bottom? Not to me. I'm not really getting bottom vibes from these stories this morning. You guys let me know. What do you think? Also, we got another merger announcement here. We've got Verizon to buy Frontier Communications for $20 billion in a deal to boost the fiber network. This one was announced late yesterday. Verizon said on Thursday it would buy Frontier Communications in an all-cash deal worth $20 billion as the U.S. wireless carrier looks to expand its fiber network. Verizon has offered $38.50 per share, a premium of 37.3% to Frontier's closing price on September 3rd, a day before reports of potential acquisition emerged. As of June 30th, Frontier had a total debt of $11.25 billion. So Frontier, apparently this story leaked yesterday. The deal was announced this morning, but somebody knew because this stock was up 38% yesterday, or 37.5% yesterday, almost exactly the premium that was being offered on the shares. Now it's given up a little bit of that, down 8.5% this morning, trading at $35.38. So it's basically bid right up to the acquisition price yesterday, giving back some of that this morning. Verizon stock, meanwhile, is actually up about 0.5% this morning, 41.73 for Verizon stock. That's up about 25 cents. And the last one of the day, C3 AI slumps 20% on weak quarterly subscription revenue. They misspelled AI is the greatest thing since sliced bread because, the stock slumps 20%, weak quarterly revenue. What's going on? I thought AI was going to blow away the whole world and change everything and put us all out of work. Well, shares of C3 AI, which makes software for enterprise artificial intelligence, slumped by 20% in pre-market trading on Thursday as subscription revenue was squeezed by slow conversions of pilot customers. In other words, we give people a taste of our AI product and none of them want to pay for it when the pilot program is over. Shocker. High interest rates and an uncertain economy have led to cautious spending by enterprises, which have kept a tight leash on costs. The company reported subscription revenue of $73.5 million in the first quarter, missing estimates for $79.1. For the company, subscription revenue is comprised primarily of software licenses, software as a service offerings, pilots and trials of C3 AI applications or generative AI, and consumption-based pricing for which revenue is recognized. C3 had weakness in subscription revenue, which decreased by $6.5 million quarter over quarter, compared to adding $9.5 million last quarter and $5 million in the same period a year ago. Management said it continues to expect pressure on gross margins due to a higher mix of pilots, which carry a greater cost of revenue during the pilot phase of the customer life cycle. The company, whose shares more than doubled last year, is set to lose more than $600 million from its market valuation of nearly $2.97 billion if those losses hold. For the reported quarter, the company posted total revenue of $87.2 million, which is an increase of 21% and beating estimates of 86.9%. But what's the point of beating revenue estimates if you're still losing money? You're just losing money faster. $600 million in losses on a $3 billion valuation. Not a good sign for C3 AI. That stock is looks like it's recovering a little bit. It was down 20% at one point pre-market. Now it's down 14.4%, trading at $19.64 after the opening bell. So, surprise, AI doesn't make money. It's not like I've been warning about that for years or anything, but I digress. I want to say thank you so much to Mr. Mighty Mike, who says the 10-year, 2-year calling for a 50-point rate cut. You know what? I did see that, especially yesterday, Mike. Let's shrink me again. After we got that much weaker than expected JOLTS report yesterday. If you look at CME FedWatch futures right now, it looks like the market is still favoring a 25-point cut here, 55% versus 45% for the 50 basis point cut. But I would add that a day ago, the odds of that 50 basis point cut were just 34%. So they're up a little bit here. The market is pricing in a more aggressive or a more dovish Fed, although right now it's a pretty even split, 25 versus 50. Tomorrow is going to determine what the Fed does. All right, if we get a really weak number tomorrow, the Fed's going to go 50, and they're going to have egg on their face for waiting too long. If we get just a meh report tomorrow, 25 probably still happens. Right now, I'm still in camp 25 with the asterisk that a lousy number tomorrow will make that much, much worse. Thank you so much, Mighty Mike 53, for the super chat, sir, and the support of the channel. And thank you to Mr. Charles Coughlin, says Nvidia versus the DOJ. I'm rooting for injuries. Yeah, the Department of Justice fighting Nvidia. Who wins? I don't know, America, I guess. That's the one way. I have no love for either organization myself. But I'm curious, what do you guys think, about that Nvidia denying the subpoena? Did the press just get the story wrong? I mean, anonymously sourced. I'm not a big fan of anonymous sources, people not naming their sources, right? So anybody could make up anything and then hide behind anonymity. So there's always that possibility. Journalistic standards are very low these days. But at the same time, Nvidia just saying, no, it's not a subpoena when it could have been a civil investigative demand, which is essentially the same freaking thing. And that's why all the lawyers call it the same freaking thing and refer to it as the same thing. Maybe they're just splitting hairs. I don't know, Charles, to be honest with you. I have very low expectations for both sides of this debate here. So we'll know more about it in the future. The one important asterisk I would add in some of my research this morning about the difference between a subpoena and a civil investigative demand. The civil or whatever it was, right? The demand for information, the longer worded one, those tend to be issued before an indictment, whereas a subpoena is issued after an indictment. So it's possible that they're just splitting hairs here and saying, well, we haven't been indicted, so it's not technically a subpoena, even though if they fail to comply with this request for information, they're opening themselves to legal liabilities every bit as much as a subpoena. It's the same freaking thing. It doesn't really matter. Thank you so much, Charles Coughlin. I appreciate the super chat and the support of the channel. And thank you, everybody, for having your coffee with the Melonheads once again this morning. Thank you guys for the super chats. And thank you to all my magnanimous Melonhead members on YouTube and Patreon. Appreciate everything you guys do for the channel. Looking forward to talking to you guys on our weekly Zoom today at 7 p.m. Eastern Time. We're doing it a little later tonight. Links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Till next time, everybody, live small and dream big.